6 million ounces of deliverable silver just vanished from COMEX vaults in a single session. At the exact same time, the exchange that spent 6 months hiking margins to crush traders just slashed them by 22% in one move. Not gradually, not in phases, one cut, one night. At the precise moment when physical inventory is bleeding out faster than it has in years. That timing is not an accident. That sequence tells a story. And if you don't understand what that story means, you won't be prepared for what's coming next. I'm Roxanne, and today we're going to break down exactly what the CME just did, why they did it, and what it means for anyone holding silver or watching this market. Because what happened in the last 24 hours changes the entire game. Let's start with the announcement that shocked the silver community overnight. The CME, that's the Chicago Mercantile Exchange, where silver futures are traded, just announced massive margin cuts across precious metals. Here's what changed. Gold futures margins, cut from 9% down to 7%. Silver futures margins, cut from 18% down to 14%. Platinum margins, also trimmed to 13%. All of it effective immediately after yesterday's close. For silver, that's a 22% reduction in margin requirements in one move. Now, if you're not familiar with margins, here's what that means in plain English. Margin is the amount of money you need to put up to control a futures contract. Higher margins mean it's more expensive to trade. Lower margins mean it's cheaper to get in. When the CME raises margins, they're making it harder and more expensive to hold positions. When they cut margins, they're making it easier and cheaper. So on the surface, this looks like good news, right? Cheaper access to silver futures. More traders can participate. That should be bullish. But here's where it gets interesting. This margin cut didn't come out of nowhere. It came after 6 consecutive margin increases over the past 6 months. Let me repeat that. 6 straight margin hikes, then one massive cut. For 6 months, the CME systematically made it more expensive to trade silver. Each hike forced leveraged traders to either put up more cash or close their positions. Weak hands got shaken out. Open interest collapsed. Volume fell. The exchange squeezed participation out of the market exactly as intended. And it worked. Managed money positions in silver are now at a 20-year low. That means professional traders are holding the smallest long positions in silver in 2 decades. Even though silver went from $30 to over $120 during this run. Think about that. Silver more than tripled. And professional money managers cut their positions by 70%. That's what 6 margin hikes will do. They wash out the longs. They drain participation. They suppress the paper market. And now, with registered silver inventory at crisis levels, with physical delivery pressure at its highest point in years, the CME suddenly makes it 22% cheaper to play again. Why now? There are 2 ways to interpret this margin cut. And I want you to hold both of them in your mind at the same time. Interpretation 1. They need traders back. The margin hikes did their job too well. Open interest collapsed. Volume dried up. The paper market needs participants to function. So the CME is lowering the cost of entry to bring traders back in and replenish liquidity. This interpretation says, the manipulation worked. They crushed the rally. Now they need fresh blood to trade against. Interpretation 2. They're inviting shorts. Lower margins don't just make it cheaper for bulls to buy, they make it cheaper for bears to short. And right now, with physical squeeze risk at its highest level in a decade, suddenly making it 22% cheaper to hold short positions is interesting timing. This interpretation says, they see the physical crisis coming. They're making it easier to build paper short positions to suppress the price when delivery pressure hits. Both interpretations could be true. Both could be wrong. What matters is this. The timing demands scrutiny. The CME doesn't make moves like this randomly. They make them when they need to. And what they need right now is either more liquidity or more control. Possibly both. So how do we figure out which one it is? We watch the positioning data over the next 2 weeks. That's where the answer will show up. Because the physical picture underneath this margin cut is not ambiguous at all. While the margin cut was grabbing headlines, something else happened that barely got mentioned. The Wednesday COMEX vault report just dropped, and it showed another 6 million ounces of registered silver adjusted out of deliverable inventory in a single session. Let me put that in perspective. 6 million ounces is roughly 7% of total registered inventory, gone in one day. 7 custodians reported adjustments out simultaneously: Asahi, Brinks, CNT, Delaware, HSBC, Loomis, and StoneX, all in the same night. All moving metal out of the deliverable pool. Registered silver now sits at 81.35 million ounces. Just this morning, it was 87 million ounces. Nearly 6 million ounces of deliverable silver vanished since the last video. The rate of drain is not slowing down. It's accelerating. Now let's compare that to what's happening on the other side of the world, because this is where the story gets undeniable. Shanghai Gold Exchange silver withdrawals are now running nearly 3 times higher year over year. Not a seasonal blip, not a data quirk, 3 times. While COMEX is bleeding registered inventory, Shanghai is pulling physical at a record pace. The people who spent years being called conspiracy theorists for pointing at the gap between paper pricing and physical demand don't need to say much right now. The data is doing it for them. Now, before anyone takes this as a signal to go all in on silver tomorrow, stop. Setups don't come with timestamps. The disconnect between physical and paper has been compressing for years. It doesn't resolve in a session, a week, or a month. What this tells you is the structural picture. The timing is a separate question entirely, and anyone packaging certainty around timing is selling you something. But the setup is real, and it's tightening. Let's zoom out for a second because the silver story doesn't exist in isolation. The COMEX gold-to-silver inventory ratio has now dropped to 1 to 10.7. That means for every ounce of gold in COMEX vaults, there are only 10.7 ounces of silver. But the gold-to-silver price ratio sits at 61 to 1. Gold is 61 times more expensive than silver, but there's only 10 times as much silver in the vaults. That's a massive divergence. And it's getting wider. Now here's the kicker. For every single ounce of physical gold sitting in deliverable form on COMEX, 133 ounces of paper gold trade against it. 133 to 1. That's not a market. That's a casino where the chips outnumber the cash in the vault by 133 times. So the next time you see a sharp gold sell-off and physical prices don't move with it, that ratio is your entire explanation. Paper can reprice violently when it's 133 times the size of the underlying asset. The physical hasn't changed, only the paper moved. Which brings me to something that's been drawing serious attention in the trading community this week. And it should be drawing yours too. For 4 consecutive trading sessions, gold sold off sharply at exactly 8 a.m. Eastern Time. Not around 8 a.m., not early morning, exactly 8 a.m. Monday, down nearly 3%. Tuesday, down over 4%, all the way back to $5,000. Wednesday, down nearly 2%. Thursday, another 2% drop. $4 trillion in paper gold value wiped across 4 sessions, all triggered at the identical minute, all carrying the same mechanical signature. Natural selling does not operate on a fixed daily schedule. Natural selling does not clock in at 8 a.m. 4 days in a row. This is algorithmic. The pattern structure is familiar. It mirrors the same timing architecture that appeared in Bitcoin for months before scrutiny eventually forced it to stop. Jane Street's name keeps surfacing in the pattern analysis, and at this point, it's not difficult to see why, given their documented history of market manipulation in precious metals, crypto, and other assets. If you're wondering where the CFTC is in all of this, you're asking exactly the right question. Now here's the contradiction the paper price action doesn't want you to see. While gold is getting algorithmically dumped every morning at 8 a.m., global gold ETFs recorded net inflows of $5.3 billion in February alone. That's the 9th consecutive month of inflows, the strongest start to a year on record. Total global assets under management in gold ETFs climbed to a record $71 billion. Holdings at 4,471 tons globally. The institutional money is not leaving gold. The paper price is being moved by an algorithm at 8 in the morning. Both of those facts occupy the same market at the same time. The ones who understand that distinction are positioned very differently from the ones who only watch price and react to it. Let me give you the current state of the silver market as of right now. Western spot silver, $82. Silver futures, $83. Shanghai Spot, $93. Shanghai Futures, $95. That's an $11 premium between Shanghai and the West. China is paying $11 more for physical silver than what the paper market says it's worth. Silver dipped to $80 earlier in the session before recovering to $83. The lower timeframes are still not giving a clean technical read. On the dollar, the DXY is consolidating ahead of NFP tomorrow. That's the non-farm payrolls report, one of the biggest market-moving data releases every month. Consolidation before a high-impact data release is textbook behavior. If DXY gets follow-through and closes above the January 15 level, paper metals face additional downside pressure. If it fails to hold that level, the picture shifts fast. That's the only short-term signal that carries weight right now. Everything else is noise dressed up as analysis. As for trading this environment, the lower timeframes are not giving a clear picture, and NFP tomorrow is a complete unknown. If you think you know what that number does to the market, good for you. But the smart position right now is sidelines, and not just in metals. Equities are getting hit. The dollar is choppy on lower timeframes. Oil is spiking on war headlines that reprice by the hour. This is not a trading environment. It's a minefield. Sitting on the sidelines in this environment is not hesitation. It's the only edge that exists right now. Now let me give you the honest bearish picture, because this channel doesn't work any other way. The bearish case is real, and it deserves a serious reading. Silver pulled back to $80 and recovered, but the lower time frames remain structurally weak. The dollar is consolidating ahead of a high-impact data release, and that resolution can go in either direction with equal probability. The CME margin cut does not automatically bring bullish paper flow. It also makes it cheaper to hold short positions ahead of a major catalyst. Open interest at decade lows means thin participation, and thin markets move sharply in both directions on limited volume. War headlines reprice by the hour, and a ceasefire announcement, however unlikely, would reverse oil and safe haven positioning simultaneously. The physical market is tight. The paper market is still arguing. That argument has a resolution, but it does not have a schedule. Size your positions correctly. Know exactly what you're in before you're in it. Let me tie this all together because there's a clear story here. The physical market already knows where this is going. The paper market is still catching up. That process doesn't last forever. Here's what we know for certain. COMEX registered silver, down to 81 million ounces and bleeding Shanghai withdrawals, up 300% year over year. Managed money positions, at 20-year lows. CME margins, cut 22% after 6 months of hikes. Gold algorithmic dumps, 4 consecutive days at 8 a.m. ETF inflows, record highs while paper sells off. War timeline, extended 4 times, always longer. Oil, up 45%, pushing inflation higher. The Treasury is considering intervention in oil futures to control price. The CME just cut silver margins by 22%, while registered inventory drains at an accelerating rate. Those two events happened on the same day. That's not a coincidence. That's coordination. That's control. That's a system trying to manage a crisis that's bigger than the tools they have to manage it. The margin cut tells you they need something. Either they need more liquidity to keep the paper market functioning, or they need cheaper access for shorts to suppress price when delivery pressure hits. We'll know which one within 2 weeks based on the positioning data that follows. But either way, the physical market is tightening. The paper market is responding, and the disconnect between the two is going to resolve, one way or another. I want to leave you with this. The data is clear. The setup is real. The timing is unknown. Verify everything yourself. Pull the COMEX vault reports. Check the Shanghai withdrawal data. Watch the positioning changes over the next 2 weeks. Watch the dollar ahead of NFP. Watch whether the margin cut brings in bulls or bears. The ones who do that homework will understand what the next move means when it happens. This is educational content, not financial advice. Do your own research. Manage your risk. Never invest with emotion. The physical market already knows where this is going. The paper market is catching up. That gap doesn't stay open forever. I'm Roxanne. Thanks for watching.